Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is August the 21st, 2023. It is now 2:48 p.m. Central Time, just over an hour left in the trading day for bonds and mortgage-backed securities. We're going to talk a little bit here about what's coming up here later at the end of the week and what may help us with home loan interest rates. And we're going to take a quick look here at some other numbers and the disparity right now between the 10-year Treasury and the mortgage-backed securities and what that might mean as far as home loan interest rates improving soon. So let's dive right in. If we go over here right now, we look at we're currently down 34 basis points here on our chart for our mortgage-backed security, which is 5.5% coupon. More interestingly enough, the 10-year Treasury is up 9. All right. So we need to take a look at our technical charts here to see what that really means to us. So let's go ahead and shorten this up to where we usually are here, like about a quarter. All right. So you can see right now that this is today, and we are breaking below that Fibonacci level. We've bounced back up, but you see there's nothing really below us, right? There's nothing really below us to sustain us or become a floor of support if we break through this floor, which is at 97.313. So we don't want that to happen on the mortgage-backed security front. Let's take a look now at the 10-year Treasury. So we don't have a floor after where we are on the mortgage-backed security. Now, the 10-year Treasury, remember, this is a yield chart. So this is something that we don't want to go up. And we see that it's been going up pretty consistently here for quite a while. Right? Now, we're currently banging up against a ceiling of resistance, which is good. We want that ceiling to hold at 4.335% on the 10-year Treasury because once again, if we break through that ceiling, there's just not another ceiling of resistance over us to even go to. We're in kind of this no man's land and we don't know where we're going to go from there. Okay. Unfortunately, we don't want to go there. Now, in both cases, we really are moved away from our moving averages quite a bit, which means that we should have the leash effect kick in here pretty soon. Here's another thing that I wanted to point out. All right. So we talked about in a previous video here, the meaning of the 10-year Treasury and the mortgage-backed security and how those usually correlate, where you're usually about 1.8% over. So the 10-year Treasury is at 2, then normally your mortgage-backed security 30-year fixed is 3.8 or somewhere closely in that range. Sometimes it's down about 1.7, sometimes it's about 2%, somewhere in that range. Okay. So right now, and we talked about that as of recently, it's been riding at about 3% over the 10-year Treasury because of the premium that's being charged because of the reduced value of mortgage servicing premiums. So if you want more information about that, you got to go back and look at my video that's maybe about a week old that talked about the 10-year Treasury and its correlation to the mortgage-backed security. But take a look. We're currently at 4.338. So if my recent calculations are right, that would mean that our interest rate should be around 7.338. That's pretty much standard of where we've been, 7.338. Well, let's take a look and see. So let's go in. We're going to run our scenario here, which is our Brent Bruce Daily, very well qualified 30-year fixed conventional home loan. And once again, when you see these banks and the interest rates that are being provided, guys, I want to make sure you understand you and a consumer cannot go get those interest rates. Those are the interest rates that I'm able to offer because I am a mortgage broker, not a banker, a broker. How does that work? Well, if you see the price that Costco gets for Coca-Cola, you don't get that price, right? Now, Costco is able to offer their retail price, and that retail price is lower in most cases than what you're going to get at a general grocery store. Why? Because they're buying it at wholesale and they're buying more volume, which means that they're able to offer a lower interest rate than to the consumer. Okay, that's pretty basic business. Same kind of thing in the home loan world. The broker is buying from wholesalers. And because these wholesalers then take huge amounts of money and sell to the back end buyers, the Fannies, the Freddies, and things like that, they're able to get it for a lower price, which they're able to hand off to the broker. And more importantly, the broker doesn't have as much overhead. Okay, as a major bank, a major bank or independent mortgage banker. That's why this matters. So let's take a look and see where we are on the Brent Bruce Daily, very well qualified 30-year fixed conventional through Rancho Capital. So these are some of the banks that I get my wholesale loans from. Okay, Flagstar right now leading the charge here at 7.625% with a credit of $652. All right. Unfortunately, that's pretty high. That's about as high as we've seen since we started doing the Brent Bruce Daily. Not the highest I've seen in 21 years of doing home loans, but it hasn't been that high for quite a while. Now, here's the thing: 7.625 is more than 3% over the 10-year Treasury, because that would mean they would be at 7.33, right? We're at 7.62. Why are we seeing the disparity between 10-year treasuries and mortgage-backed securities get even further, and interest rates, I should say, get even further away from each other? And that is because I think this is another illustration of the fact that the overall investment community that is putting their stock in service release premiums, the amount of money they make for servicing the home loans, creates a certain value when it comes to a mortgage-backed security. They're not seeing as much value because, again, they expect those home loans to be refinanced rather quickly, which means they're not going to make as much revenue on interest. They need to make the money on some sort of premium or fee. All right. So as home loan interest rates go up, it kind of makes them move away from the 10-year treasury even further, because they're not getting as much value in the servicing of the loans, because it illustrates that the buyers and the investment community feels that home loan interest rates will come down in the near future and will cause refinances and early payoffs. So this to me is just another indication that people are feeling more and more that, hey, you may sell a 7% interest rate loan today, but I'm not really feeling comfortable that I'm going to be able to make 7% if I buy that loan from you. Not for very long, because it's not going to take very long before Mr. and Mrs. Smith refinance that loan as home loan interest rates go down in the near future. And now I'm out and I'm not making 7% anymore on that money. Now, normally there are statistics as to how long a home loan would stick around. How much interest would be gained from that type of an investment. And it's going like this. It's shrinking in their eyes, because they know that as home loan interest rates go up, the probability of refinance goes up as well. All right. So I think that's an indication that we again see the investment community feeling like home loan interest rates are getting to their peak and should be coming back down again soon. So that is what is going on here. Let me know your thoughts, concerns, questions. Make sure that you like, subscribe, share, and hit the notification bell down on the bottom. And I will see you again tomorrow.